Welcome to my new podcast, Commercial Lending with Brad. I'm very excited to be bringing this new podcast to you where we can discuss what's going on in commercial lending. And this podcast is for business owners, commercial real estate investors, and anybody who works around that industry. If you want some background on me, I've been in commercial lending for over 25 years. I've been running Commercial Lending X for 13 years. And we specialize in two things. We do bank consulting work, but we also do commercial lending. Over my career, I have underwritten over $5 billion in commercial loans, and I personally have originated over $2 billion in commercial loans. So I'm coming at this with a really good background for commercial lending. I hope to bring some good guests that can bring other facets of lending to the table and help educate you about what's going on. Our goal is to provide you with current knowledge of what's going on in the commercial lending world, directly related to what's happening socially, economically, and politically. So with that said, I'm going to dive into the first episode, which is all about me and my experience, and talking to you about how that relates into what's going on in the market today. And I will tell you, I am getting tons of questions based on what's going on in the economy and with interest rates. And so I'd really like to take this as an opportunity to share my knowledge with you. So I'd really like to give you my perspective on what I see going on in the economy today. Let's dive into the questions that I've been getting a lot. The first one is, where are interest rates today? I wish there was an easy answer for that. As I keep telling my clients, the way things have been moving is just crazy. I can't peg lenders down. I talk to a lender one day, get a quote, completely different the next day. It's just crazy times. So in general though, interest rates are at 6% or higher. If you're looking for a fixed rate, you could be into 6 to 7.5% range for a 5, 7, or 10-year fixed rate. If it's variable rate, you're probably at prime, which starts at 7%, to prime plus 1 or 2%. Could be even as high as 3% if you get an SBA loan. So that would put you in the 7 to 10% range. I know, crazy times as it relates to interest rates. The second question is, where do I think interest rates are going to go? Personally, I think they're going to continue to move higher. The Fed is going to be forced to act to try to continue to tame inflation. Although the inflation numbers for October came in slightly better, the Fed has this habit of overcorrecting, and they're going to repeat that habit. Rates are going to go higher, and what we're eventually going to have is a situation where the economy is going to slow. I believe that slowdown in the economy is going to happen next year, which is going to lead to the Federal Reserve lowering rates in late 2023 or early 2024, which brings an interesting question to the table. If you have the opportunity to take a fixed rate today at 7% or higher, or possibly even at 8% or 9%, do you do that? Or do you take a variable rate loan in hopes that interest rates are going to come down in the future? I personally have been advising a lot of clients on variable rate products like SBA products where they could take a fixed rate today in the 8 or 9% range. I'm advising clients to go with the variable rate versus taking that higher fixed rate product. The reason being is they're going to be stuck in that loan if interest rates come down, and it's going to be very hard to refinance that loan. But if they take the variable rate, the risk of rates going up that much higher versus where they are today versus how much lower they could go into the future, there's a way bigger benefit on writing those interest rates down. The third question I've been getting a lot is, how have business values and property values been impacted by what's going on in the economy, and specifically higher interest rates? It's very interesting when you look at real estate and business values. When you're selling a piece of real estate, you're always looking at what sold in the previous 2 to 3 months. And what sold in the previous 2 to 3 months was probably put under contract 2 to 3 months before that. So you have this 4 to 6 month delay in the market whenever there's a change in interest rates. So what things are getting priced at today is kind of off of where interest rates were 4 to 6 months ago. So we have not seen business values and real estate values come down yet, but it is finally starting to happen. Since this most recent rate increase, enough time has passed and we're starting to see a break in values. I do believe that is going to continue going forward, but I don't think it's going to be broad-based. I think certain commercial real estate assets are going to have to come down in value due to higher interest rates. I also think different businesses are going to see a lower multiple being paid for them because of higher interest rates. But overall, certain areas of the economy are still very healthy. There's still a lack of inventory in residential. Although what people can afford today is less with higher interest rates, unless there's a big mass of people selling at steep discounts, I think you're going to see residential real estates hold up better than they did during the previous downturn. But overall, we are starting to see values decline. So if you're looking to buy a business or buy real estate, it's a good time to do so. It's definitely a good time to think about it, but you may really want to watch closely what's happening here and try to get it as it comes back down, especially as interest rates hit their peak, because that's when, probably within 3 months of interest rates hitting their peak, is when values are going to be most impacted. The fourth question I've been getting is, what's the state of the economy? We already talked about what's going on with interest rates, and certainly that's impacting the economy. I will tell you, I deal with a lot of business owners, specifically small business owners, and what I'm seeing in as far as financial statements they're providing this year compared to last year's numbers and 2020, certainly their numbers are way ahead of 2020, COVID impact and all that good stuff. But I'm seeing the 2022 numbers as the year goes on, revenues going flat or even trailing down. But more importantly, I'm seeing profitability getting hit. And the reason why I'm seeing profitability get hit is higher costs. Inflation is having a negative impact, and it is really causing trouble for a lot of businesses right now, whether it's wage pressure, raw materials. There are some signs that some of that is going to break here soon. And certainly this isn't an assessment for all companies. We do have companies that are seeing higher profits and higher revenues. But the percentage of companies I'm seeing with either flat or lower revenues or lower profits has skyrocketed compared to last year. So I do believe that we are very close to recession, if not already in a recession. 2 quarters of negative GDP historically has been the definition of a recession. But it wasn't in this case. A lot of people are claiming the third quarter was positive, and it was positive. But if you pull out the increase in inventories and the huge increase in government spending in the third quarter, you actually ended up with a slightly negative GDP. To me, this is concerning. You couple this with the rising interest rates as fast as they have been and the struggle we're seeing that have on borrowers, especially borrowers with variable rate loans, I do think you're going to see a pickup in defaults, you're going to see more layoffs, and you're going to see some issues. So I definitely think a recession is ahead of us. However, I don't think it's going to be that bad. I think the core economy is still strong. There's plenty of job demand. This isn't going to be a typical recession. In fact, no 2 recessions are ever the same. But this is going to be a recession with still high job demand because there still are a lot of growing industries. And I think we'll turn out of it fairly quickly. And the last question I've been getting, and probably one of the most important questions for you if you're looking to borrow money, is how have current economic conditions impacted commercial lending? And quite honestly, there have been some impacts. Lenders are stress testing the interest rates on new loans they do more than they ever have before. And it makes sense, right? Interest rates have just gone up the most that they've ever gone up. So that's creating a situation where if you're going to get a SBA loan at prime plus 3, which is 10% today, that lender's probably stressing that loan at 12 or 13%. That higher level of stress is going to decrease the amount of money you can borrow. It's going to require you to have more cash flow to borrow the same amount of money. That is going to also push values down in some circumstances. We're also seeing lenders very nervous about the economy and certainly industries that are heavily impacted by recessions. What are those industries? Travel, entertainment, leisure. Other industries severely impacted are high-end consumer goods companies like car dealers, boat dealers. So if you're in these industries, you need to be aware and watch market conditions and be prepared. But overall, lenders are starting to tighten their criteria, and there are some lenders that are starting to push borrowers out. So if you're in one of those situations, know that there are other options out there for you, and you're probably not alone, but that there are changes coming to the market because lenders are certainly nervous about what's going to be going on going forward. So I know this initial podcast has sounded a little bit doom and gloom. I didn't intend it to be that way, but I just wanted to kind of get the facts out there about what I'm seeing on the ground so people in the industry are aware and they're ready. And they understand when they're going to maybe have some difficulties getting that next commercial loan. But with that said, there are tons of positives we should talk about. Politically, it looks like we're going to have a split government. Split government historically has been very good for the economy. Not a lot happens when you have a split government, and what does happen takes compromise. It's usually good for both sides. Also, split government should slow down some of this heavy government spending that has really driven those inflation numbers. The core economy is strong. Look at the job market. Even if we get some of these layoffs and some of these economic issues come together, there's still room and job demand in other industries. Some people may have to make some changes, but I think overall, we're going to be in pretty good shape from that standpoint. If you're looking to borrow money, in today's market, there's more lending programs than ever existed before. There are lots of non-bank lenders out there. There are lots of banks that have created offshoot programs. There's just a lot of alternative options out there that didn't exist in the past. So you should still be able to find a way to get that financing that you need. May not be at the same interest rates that you would hope for, may not be at bank interest rates, but still the key is getting the money you need to survive, whether it's for your piece of real estate or whether it's a business loan. And a lot of people are concerned about a repeat of the Great Recession of 07 and 08. And I don't believe that's going to happen. Things are substantially different today than they were then. And a couple of the key differences are, first, banks and capital. Banks have way more capital today and higher capital requirements than they did back then, and much larger loan loss reserves. So banks can sustain a downturn much better than they were able to in 07 and 08. Also, the housing market was a key part of the crash in 07, 08. When housing values went down, borrowers said, I don't have equity in my home. I'm not going to pay my mortgage. I'm going to walk from my home. But that was coming off of a time period where mortgage rates had been 5, 6, 7, even 8%. We just came off a period where most people refinanced in the 2% or low 3% range on their mortgage. Even if their home's underwater, that mortgage payment that they have today at that low rate is probably going to be better for them than if they have to go rent somewhere else. So I don't believe people are going to give up their homes. Even if they lose their jobs, I think they're going to fight like hell to keep those homes, just to keep those mortgage payments versus having to pay rent, even if they don't have the same amount of equity in those properties. Overall, we're in a much different time than we were in 07 and 08. I think there's a lot of positives going on. I don't think the next year is going to be without some struggles. Higher interest rates are going to continue to cause some problems. Banks will continue to be tighter on capital, but there's plenty of opportunities to move things forward. So if you're thinking about getting a new loan, expanding your business, buying an investment property, refinancing your investment property, there's still products out there for you to do it, and it's not necessarily a bad time to do it. Just be sure you weigh all the risks and you look at those products that make the most sense for you. We are always here to provide an assistance and help you. And I look forward to seeing you on the next podcast with Commercial Lending with Brad.